Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, so today Mena and I would like to talk about the top 5 reasons why businesses fail. And we all know the statistics, right? Only 20% of businesses last 5 years, and only 20% of that 20% last 10 or more years. There's a bit of survivorship bias in that data, I reckon. There's going to be some businesses that have been merged or acquired, that might not be in their own right, but still are kind of continuing. But I think the answer here is that most businesses fail. It's pretty challenging in terms of building your own business. And also, it's not for everyone. So I think it's not only just because it's challenging, but people may change their mind, right? That they decide to tackle business, but then it doesn't work out the way they want, and then they change their mind. So it's not all just about because it's so hard. Nevertheless, we thought it'd be interesting to talk about what are the 5 most common reasons businesses fail. And maybe it gives you a bit of food for thought of what areas in your business, if there are any weaknesses, that you need to sort of focus on. So let's start off with number 1, and cash is king. So businesses run out of money. Cash is really the lifeblood of any business, and making sure you've got enough working capital, that you've got a sustainable business that's producing a sustainable level of profit is absolutely critical. We can take some lessons out of this. For example, in Germany, there's a lot of large family businesses in Germany. In fact, if a business lists on the German stock exchange, typically they only list a small portion of the equity in that business, that the majority will still be sort of owned by the original founding members, the family. And that's true whether the family are actually still working in the business or not. And a lot of those businesses in Germany don't hold debt. Or if they hold debt, they hold very, very little debt. And this is something Warren Buffett's talked about, particularly with Berkshire Hathaway sitting on a huge pile of cash. Having a large amount of cash and very low debt means that you will be able to survive almost any downturn. If you have high levels of debt and low levels of cash, the reverse is true, of course. And that's really what's going to make it more sustainable. Now, of course, you could have an owner that bleeds a business out of cash, goes and spends that cash on lifestyle assets or whatever, and that's more challenging as well. And you would just want to make sure that you've got the right buffers in place. But not having a lot of cash in a business can be a symptom that you don't have a sustainable business, and that can be a bit of a red flag as well. So if you're always sort of struggling to pay your BAS or, have enough money in the bank to deal with any expenses, that can, as I said, be a side effect of not having a sustainable business.
So the next mistake that people make is actually venturing into the business world without a business model or a marketing strategy. They just go into it just wanting to go into business without any idea of how it actually works. So, it's really important to map out how you expect your business to work, how will you sort of create your customer base or your client base, and what your product or service is about, what your customer acquisition actually costs. Otherwise, how else would you establish your margins, or how else would you establish your pricing structure and so forth. So it's really important to actually go through these items before you actually even operate your first dollar.
The third mistake, which is kind of linked to the cash flow one to some degree, is but having a business with poor margins. You've got to think about not only do you need to pay for your own living expenses as a business owner and then have enough money to build wealth and so forth, but you've really got to think a lot wider than that. Can you scale your business? So are your profit margins fat enough so that you're able to attract good talent within your business, retain that good talent and grow it? Also, are you being fairly compensated for the amount of risk that's involved in your business? Would an investor come along and invest in your business because of its margins? Or are your margins so thin that even an investor wouldn't want to do that? Now, profit isn't necessarily the reason why we run a business, but it's a necessary consequence of running a business. So whilst you might be really aligned with, what you're achieving in your business, helping customers, selling a particular product, that's fantastic and something that I firmly embrace. But at the end of the day, you need to have a sustainable business. You want a business that is growing, that can afford to help you grow that business and is fairly rewarding you for all the time and effort. What we find though is a lot of businesses just make just enough money to pay the owner's salary, make a little bit of profit left over. To our mind, those poor margins are a recipe for long-term disaster.
The next mistake is what I like to call is complacency. It's the ability to fail to grow. So it's either that you're happy with how the business is going, you're just happy with it to tick along, you're not concerned about sort of anyone else or any competition, you're just happy with what you're bringing in. However, things can change quick. So it's important to stay on top of your business. It's important to understand your customer demand and your margins and your pricing and your costs and so forth. Otherwise, your business will die. It's either you're growing or you're dying. There's no really in between. So the decision to maintain the status quo is really a decision to die. So, complacency is not, I can't stress enough how complacency is detrimental to your business.
And the fifth one is Michael Gerber wrote a book called E-Myth in the 80s, so a long time ago. And I mentioned it in this podcast previously. Anyway, he's quoted by saying nothing has killed more small businesses than more sales. And the reason for that is because they just aren't ready to scale the business. They aren't ready to deal with the growth, either from an operational perspective or maybe from a pricing perspective. But, whatever it is, it's just not going to work. And you see this in hospitality all the time. So you get a business that's doing really well, then they expand, but they haven't thought about, expansion comes with greater risk, expansion comes with greater overhead cost, and they haven't factored that into the price. So whilst they're doing well, like their restaurants are really busy, the more plates of food they sell, the more money they lose, or the more risk that they're taking on that they're not being compensated for. And eventually one day that cafe restaurant chain is no longer around. And it's a really good example because they can grow very quickly and they grow before our eyes. It's easy to witness those things. So I thought it was a good example to use, but really it resonates in my mind. You want controlled growth and you want, most importantly, profitable growth. And so the question then is to be asking yourself, if you want to double your business or triple your business, what do the numbers look like? And speak to your holistic accountant about this, just to make sure that you've got the right margins and right provisions to be able to grow profitability. So there you go. They're the 5 mistakes: running out of cash, poor business model or marketing strategy. These you can't attract enough clients, poor margins, you fail to have that growth mindset, or you grow actually too fast. Anyway, they're food for thought, and until next week, bye for now.